Let's talk about the interest rate, okay, and the yield. And interest rates, it has some meaning for the present value for the bonds. And knowing about the interest rate, as we say, is very important. The interest rates are like the heartbeat of our economy, and they get a lot of attention in the news for good reasons, right? So they influence what? They influence everything in our life. So because they directly impact our everyday lives and they influence our decisions, like whether to spend, whether to save, or whether to buy something, like buy a house. Okay? Or even if you want to invest. So think of them as the weather forecast for your financial choices. To know interest rates, we have to monitor what? We must know about several concepts in finance that they are important to be reviewed. So the first item that is important related to interest rate is the present value. Okay. The second one is the yield to maturity. Okay. So what is the yield to maturity? The most accurately measured to reflect the interest rate. The present value is the future value over the interest that is in the market. So the present value, or PV, okay, at the time 0 is the future value that we over what? Over 1 plus interest rate, okay, over of n. Another item is the current yield, okay. So the current yield is what? An approximation of the yield to maturity. We can have also the yield on discount basis, that is also an approximation for the yield to maturity. We have the interest rates and returns concept that is very important for the financial system, because the returns is something that can show the whatever you gain, you had to gain from the market. And the relation between this return and the interest rate is also very important to be analyzed. And to have a good return, we have the risk that we have to manage. So the interest rate risk will get importance here. And also the real and nominal interest that we have to know about the real interest rate rather than the nominal interest rate that might be very different in the market, and considering all the other factors like the inflation is also very important. So the real interest rate is what? The nominal interest rate minus the expected rate of inflation, right? So the real interest rate is important to be known by what? By this nominal interest rate minus the expected rate of inflation. Okay. So the interest rate is important to be known, to know how much to spend, how much to save, if you want to buy an asset like a house or invest in some more liquid assets. And knowing about these concepts are important to analyze the interest rate, okay? So we have the present value, the PV, that is the future value over the 1 plus the discount rate, okay? So for the rate of return. And this n, that is the number of periods. So discount rate, number of periods, and future value must be known to calculate the present value of the asset or the bond. And we have the what? We have the also yield to maturity. That is very important. So the main concept is the yield to maturity, and we have some simple way to calculate the yield to maturity, such as the current yield and yield on a discount basis. That they are not very accurate, but they are very simple to be calculated. Okay, so if we consider the yield to maturity, it's important to know about the interest rate and about the yield to maturity, to know about the bond price. So basically the relation between the interest rate and the bond price is something negative, okay? So the relation is opposite, and the correlation would be what? Negative, okay? So if we consider here the interest rate at the other side and with the opposite direction, we will have the bond price. Okay. So for long-term bond prices have substantial fluctuation. That is always the case. We will have what? We will have the risk and the interest rate risk. That is important to be known because it's about what? It's about capital gains and losses, okay? They can be large because of the interest rate risk and the long-term bond prices that they have the substantial fluctuation. So if we have this interest rate risk, that we have it for long-term, and for some bonds we are investing in long-term, we will have the capital gains and losses that it might be large, okay? And for long-term bonds, we will have a high interest rate risk, and they could be considered for the long-term bonds to be very risky assets, okay? So they are not considered to be safe assets with a sure return in long term. So the risk is also high. Okay. So we have to calculate this yield to maturity, and in a simple way, we can calculate the current yield that we have it here. This current yield is what? Is the annual coupon that we might have for the bond over this current bond price so the yearly coupon payment divided by the price of the coupon, okay? And it's a very simple way to calculate the yield to maturity. But of course, the yield on a discount basis, the yield, the current yield, they were a very good way to calculate the yield to maturity at the time that we didn't have the computers and the computational power and the softwares that nowadays we are using. So very simple way to deal with this yield to maturity calculation, and whatever we have to know about it for managing the interest rate and knowing about the risk that we are taking from these bonds and the assets that we have in our balance sheet. Okay, so we have these concepts that they are all important. We have the inflation rate that we have to consider it, okay, the real and nominal interest rates. So the inflation rate is very important. And if we consider, for example, the nominal interest rate, so let's say nominal interest rates here, and then we consider the inflation rate here, okay? And then the target rate of inflation, for example, is 2, okay? So this is the target rate. Of inflation. So from this target rate of inflation and the monetary policy rates that we have for the interest, so let's say we have also the monetary policy rates. Then we might have a nominal interest rate that we can see as something like this. Sorry, it should be here. Like this. And then the 45-degree line that we might have it as this. It will show us what? The real rate of the interest, okay? Would be the real rate interest that might be different with the monetary policy rate. Okay, so the real rate is a good measure of tightness of credit market condition. Okay, not the monetary policy rate that is a kind of nominal interest rate. So this is the relation between the nominal interest rate and the real interest rates that they have to be considered for the interest rate risk management. And the real rate is always important to be considered, okay? So the current yield and the yield on a discount basis, they are a kind of approximation for the yield to maturity. And we could see the current year yield as the annual coupon over the current bond price. And if we want to know about the yield on a discount basis, so yield on a discount basis is what? Is actually equal to the face value, okay, minus the purchase price over the purchase price times what? The number of days in a year over the years to maturity. Okay, so less accurate measure of the yield to maturity, but we might monitor the changes in their direction as a signal. Okay, so they are not very accurate estimation of the yield to maturity, but it is always good to monitor the direction to see the possible direction of the real interest rate in long term, and it could be a signal, right, for a change in the same direction for the yield to maturity. So yield to maturity is not completely or very accurately estimated by yield on a discount basis, but it could be a kind of signal for the direction.